Hello, Business 630 students. This is Professor Hassey, your instructor for this Spring 2 session of Corporate Finance. This is our second video of our course. I posted a introduction course video over the weekend. Hope you've had a chance to see that and get used to our course, way it's set up, our Blackboard, and all that sort of thing. And this is our first week 1 lecture video. As I said in our introduction video, I will produce or show a video every Monday and Friday every week throughout the 8 weeks of our course. I'm a little bit late this week. Today's date is Tuesday, April 4th. I'm a day late. I apologize. But I was hoping you'd all catch up and get caught up with me by looking at our introduction work over the weekend and yesterday. So our topic is corporate risk this week, number 1, and we're going to review risk and return in the concept of corporation financial management. And that's our first topic this week. One of the things that we need you to do this first week is post to the discussion forum, which is in Blackboard, and I'll show you that in just a minute. I talked about that in our introduction. What I'd like to do is hear from you all and give me a brief bio about yourself and how you got to this point in your academic career. And secondly, I'd like you to select a Fortune 500 company, one company that you will look at throughout the 8 weeks of our course. You'll do a case study on it, on this company, and you'll do some other work. Pick one Fortune 500. If you don't know what Fortune 500 is Fortune 500 is a business magazine that doesn't select, it lists the top 500 corporations in America doing business in America by their total sales, their revenues. So I want you to pick one of those Fortune 500, and that'll be a company you'll work with throughout our course. Every week, I will have an agenda posted to Blackboard on Sundays, giving you the agenda and the highlights of the week. And let's just take a look at a couple of infrastructure points in regards to our Blackboard. I hope you've gotten familiar with our Blackboard site over the weekend and ready to begin our work. Remember, this is a asynchronous course. I have a tough time always saying that, which means it's online only. There's no remote sessions, no classroom sessions that you all have to attend. It's strictly me doing videos and posting information to Blackboard and you gathering that all in and keeping up to date with our assignments and tracking our studies and our topics throughout these 8 weeks. All right. So here's our Blackboard site. If you've noticed already, we have the information in the syllabus area, which gives the highlights of the course, our grade schedule, our case schedule, and here's that introduction video that I added on a Friday of last week. So I hope you've all seen that. Then we have our course announcements file folder, which is all whenever I send you an email, this is also automatically posted to this announcement. So if you feel like you've not kept up to date, you can go to this announcement file folder and see all the emails I've sent out for our course. Then we have a Zoom and YouTube links area where I post all the videos associated with our course. Here's that introduction video of Friday. Every time I will post that to Blackboard. We have student hours every Tuesday and Thursday evenings from 6 to 8 p.m. That's when I'm available online that you can come and ask me any questions or concerns. Just click on that link and I'll be there. Also, we have the student discussion forum, and this is your work for this week. Answer week number 1 discussion forum. Part of this exercise is for you to so I can see that you know how to use Blackboard and can post to it. So you just click on this forum and create a thread and go ahead and answer the 2 parts of this discussion forum for this week. As you can see, some students have already done that. So you create a thread and you can go and process that information for this week that is due next Sunday. It represents 5% of your course grade. If you have any questions or concerns about the course, every week I will have a question and comments section on the Blackboard. You just click on that, create a thread, and if you have any questions or concerns that you'd like to share with me and the group, please feel free to post to that as well. And then we get into the week by week discussion forum or content of our class. As you can see, it's set up week by week. Here's my PowerPoint lecture of this evening, which I'll talk about in just a minute. Here's our course agenda that you can click on and see what our agenda is going to be for the week. Here's our learning assignments for this week. This is a very important, so you make sure you do what you need to do this week. My lecture video, which is being posted Tuesday instead of Monday, I apologize. Our topic this week is chapter 6 in the textbook, Risk and Return. Remember, the textbook is not mandatory, it's voluntary. You do not need to have the textbook for this class. I'm asking you to read an article, which is right below that. Please read that article, which we'll be referring to later on in our course and on our Friday video. And then a variety of different videos. Here's the introduction video again, financial risk and return, good discussion on that, and so on. All these videos help you understand risk and return of our key topic for this week. So that's where we are with our Blackboard. So again, for assessment grades this week, you have your graded post in the student discussion forum, student bio, and company selection due Sunday, April 5th, which represents 5% of your course grade. So every week you might want to check into each week, find the agenda, look for the learning assignments, be up to date on what you need to do and be aware of as far as your study for this week. So let's begin our lecture for week number 1, risk and return. So before we get started with our lecture for this week, risk and return, let me tell you a little bit about myself, Professor Hasse. I've had some of you in class before, but many of you I have not. I am a professor here at the University of Laverne, have been a full-time faculty member since 2018. Before that, I was an adjunct faculty member for 25 years. So I've been associated with Laverne quite a while. Why did I become a full-time faculty member? Because I retired. I sold my business. My business was investment banking. I was an investment banker, had a firm in Pasadena and Claremont where I raised capital for small and mid-sized companies and also managed some investment portfolios for some clients. I was an investment banker for 30 years in my own firm, sold it to my employees in 2017, and was a pretty good deal for everybody. They got a nice company, and I got a nice retirement check every month. And so when I did retire, I was kind of left trying to figure out what I wanted to do. I could do some consulting associated with my firm, but I decided to get into teaching. I've really enjoyed being an adjunct at the University of Laverne and some other universities. So I began teaching here full time. I teach accounting and finance. Why accounting? Well, I was originally trained in college as an accountant. I was an accounting major. Then I took a job for a company called JP Morgan, which is now called JP Morgan Chase in New York as a financial analyst. After about a year or two of doing that, I decided, this accounting side of the business wasn't too exciting for me. And I went and got an MBA in finance, and I decided to become a investment banker and got into the investment banking business with that bank. Developed a good client base and was able to break away and start my own firm out here in California, and did that for 30 years. So I have some experience in both accounting and financial management investments. So I hope to bring that expertise to our class. One of the key points of corporate finance is to maximize shareholder value. In other words, bring the greatest return to your owners of your business. Now, what's an owner of a business? Well, it's naturally your stockholders. What's another owner of your business? Your lenders, the banks, the bondholders who lend you money. You need to produce and pay those monies back. They also are owners of your business. What is another owner of your business? Your employees. You want to maximize returns so your employees can get a nice increase in their pay and increase in their benefits. Employees are a owner of a business. And finally, your vendors and your customers, people you do business with. Those are also owners of a business. And sometimes that can be a little bit overwhelming, as we can see here by George Washington on the dollar bill. Risk and return is one of the priorities that determine maximization of corporate value. What is the risk and what is the return to offset that risk in the market? Corporate finance is important to management because the knowledge of capital budgeting, capital structure, and working capital provides for effective decision making if the corporation is to maximize profits and stay competitive for future success. That's the MBA definition of corporate finance. A couple of key points there. Capital budgeting, the investment in assets to provide an adequate return. Capital structure, how you finance those assets. There are three ways legally a company can obtain capital. You can borrow it, short term with no interest, and long term with interest. You can issue equity. You can issue stock. You can issue private equity. You can have partners. The issuance of equity is the second way of obtaining capital. And the third way is making a profit. Debt, equity, and profits are the three ways of obtaining capital to invest in assets to grow your business. And finally, what is working capital? Working capital is short-term assets and liabilities, managing the short-term cash flow of your business, cash, accounts receivable, inventory, accounts payable. Managing those on a week-to-week, month-by-month, short-term basis provides effective discipline for long-term capital management. So those are the key areas that we're going to be concentrating on, which is in the macro view of what we're trying to do here. We're trying to maximize shareholder value by managing the capital structure where we get capital from and selecting the assets to invest in to grow our business. There are three main principles of corporate finance. The investment principle, which is to earn a return over the cost of the capital, which is sometimes called the hurdle rate, or for some of you just coming out of a business finance class, the weighted average cost of capital. You want to earn a return more than your cost, which is rightly so. That's the investment principle. Next is the financing decision, what we just talked about with capital structure. You want to find the optimal mix of borrowing money and issuing equity to provide the cheapest form of capital you can to purchase assets and run your business. Because that's important. Cheaper capital makes for greater value. And one of the things going on in the economy right now is inflation, the future of inflation, how it's haunting many business decisions now. Interest rates higher, interest rates lower, makes for a very interesting scenario and the cost of capital to run a business. And then finally, the dividend decision, which is the return decision. How do you get the return to your investors? Do you pay them dividends? Do you give them stocks? Naturally, you pay the interest and the principal on the debt. How do you return that return to the owners of the business? Is a whole nother discussion that we'll talk about throughout this class. Those are the main strategies that corporations use to maximize the value of a firm. The capital asset pricing models begun to talk about in chapter 6 of your textbook, and many of you probably have already run into this. The capital asset pricing model is the main formula to determine risk and return in the market. The capital asset pricing model is a formula. The risk-free interest rate plus the market premium rate times beta gives you the required return on equity in your company. It's called the security market line. It's based on the risk of zero risk in the market, which is the risk-free rate, the risk in the market for average stock returns, and the specific risk in the market of your company. So if you look at it here, the example is the risk-free interest rate, which is the 10-year United States Treasury yield, which currently is about 3.5, 3.6% in the market. In this example is 1.62%. The market premium rate is the market return on the New York Stock Exchange or the S&P 500, which in this example was 10%, minus the risk-free rate, which is called the market premium of 8.38%. That 8.38% is multiplied times the beta of, in this case, Apple Computer. Beta is 1.22. That's the risk in the market, the beta coefficient calculation that's talked about in chapter 6. And many of you probably have run into that already. Beta is a value of comparing the returns of the market to the returns, in this case, of Apple Computer. Zero beta is the risk-free interest rate, no risk at all, zero beta. The market interest rate of the S&P 500 is a beta of 1.0. And in this particular case, Apple, as you can see, is a little bit riskier than the S&P 500, 1.22. You do the arithmetic and you find that Apple's expected return as of the market indicators today is 11.84%. That's the risk in the market in this calculation for Apple Computer. In other words, if I want to buy stock in this example of Apple Computer, I should expect, based on the risk of Apple Computer of 1.22 beta, I should get close to 12% return on that stock over the next 12 months. Now, will I get that? It's up to Apple and how they run their business. But that's my expectations, and it's called the capital asset pricing model, a measurement of risk in the market of a particular company. Huge. This all leads to what is called the intrinsic value of a company, its true value. Remember, our goal is to maximize shareholder value as a corporate financial officer. Well, how do you maximize value? You take the potential free cash flow or the cash flow being generated off the assets over the next few years, divided by the cost of the money, and you can get a projected value of the stock or the company today. You want that value to be naturally farther north of the book value of the company on the balance sheet, and maybe hopefully greater than the market capitalization or the market value of the stock of the company, which is the current stock price in the market times the number of shares of stock outstanding. The intrinsic value is called the true value, taking profits and expected cash flow, dividing it by the current cost of capital. We'll talk more about this as we go along. Free cash flow, which we just talked about, is the cash generated from the operations of the business. 5 uses of free cash flow. In other words, you use cash to pay your bills, sell your products, and whatever cash is left over is called free cash flow. What's left? Operating cash flow of your business. And you use those operating cash flows to pay interest on your debt, pay back principal on debt, pay dividends, buy back stock, or make investments into other assets of your business. What is the business generating for cash to use in these other uses of cash? One of the main determinants of intrinsic value is the cost of capital. What does it cost us to borrow money? Which is pretty simple. It's the actual interest rate on the debt, less the tax shield. Remember, interest on debt is tax deductible for corporations, kind of just like it is for individuals up to a point. The cost of debt after tax is taken into account with the cost of equity. The cost of equity can be determined by the capital asset pricing model that we just talked about earlier. Combine those two and weight them by the capital structure of the company. What is the capital structure of the company? What percent of assets are funded by debt? What percent of the assets are funded by equity? That's your capital structure. Weight those by the costs, and you determine your cost of capital. Your return of your investments and assets should be greater than that cost of capital in order to provide maximum return to your investors. And then we get back to the main areas of the markets that tell us about risk and return. And these next three slides are kind of interesting. By the way, in Blackboard, this PowerPoint is in my week 1 file folder called In Class Review and In Class Lecture, and you can see this. But here's the, if I consider the 9 most important financial indicators that I track if I'm running a company. The Dow Jones Industrial Index, which is the top 30 stocks in America as determined by the Wall Street Journal. The Standard & Poor's 500 Index, which is the top 500 companies by sector, retail, manufacturing, transportation, whatever, by the company Standard & Poor's. And the NASDAQ Index, which is the over-the-counter exchange in New York, which does investments for many mid-sized companies around the country. Those 3 indexes are our equity markets. And here we're tracking the equity markets from 2019, 2020, 2021, and currently from 2022 to as of last Friday, the close of the first quarter of 2023. And look at the equity markets for this year for the first 3 months. The Dow is up 0.4% compared to December. The Standard & Poor's 500 is up 7% from December. And the NASDAQ exchange is up almost 17% since December. Equity markets didn't have a very good year last year. 2 years ago, where their growth rate was not as strong. Oops, going backwards. But now they're coming back with higher inflation that's kind of freaked out the markets for a while. But now it's beginning to come back. That's the equity markets in America. Then we have what is called the risk-free interest rate, the 10-year United States Treasury yield. If you lend buy $1,000 U.S. Treasury 10-year bond today, the interest rate is 3.491%. In other words, you'll get roughly $35 a year on lending your money to the United States government for 10 years. That's compared to about 38 bucks at the end of December 2022. That's the risk-free interest rate. That rate drives credit cards, mortgages, prime lending rates to corporations, the 10-year U.S. Treasury yield, the risk-free interest rate. Then we have the two leading commodities in the markets, oil and gold. Oil is down about 5.75% this year. Gold is up about 8%, which is rightly so. Usually in inflationary times, gold goes up. It's a hedge fund. It's an alternative investment. And then finally, the final 3 is the currency markets, the relationship of the euro to the United States dollar, the relationship of the United States dollar to the Chinese yuan, and the relationship of the United States dollar to the yen. As you can see, the United States dollar has been holding firm as always to these 3 currencies. In other words, the dollar is very strong these days. So all these factors tell us about the current state of our markets, the current state of risk in the markets, and where does our company fit into all this? That's some of the key decisions of this class in corporate finance. And you'll be doing that as well with the company that you select and tracking that using this market data as a backstop. The Franklin, the Chinese yuan, the euros, all of these drive our markets. It's globalization. That's our markets now in 2023. Nothing's local. Everything has to do with what's happening all around the world. And that's a key part of risk and return in corporate finance. In our discussion video or in our video on Friday, we'll be talking specifically about risk and return, looking at some of these topics that we talked tonight, but it all drives around how you can get capital in the markets, how you can get capital and provide proper funding for the assets which will grow your business. Being an MBA student in corporate finance means finding the strategies that maximize this return at the cheapest possible cost of capital. That means management of the assets, of the liabilities, of the equity holdings of your company to provide total return at little or low cost. Very challenging in high inflationary times that we are in today. So as we begin our first week of study this term, one of the things you need to concentrate on is number one, get used to our Blackboard and our class structure. Get to know where everything is. Tell me a little bit about yourself and pick a company from the discussion forum. And then begin to study risk and return by taking a look and reading this article, Efficient, Chaotic, What is the New Finance? Now, even though this article was written in March of 1993, it's very relevant to 2023. Trust me. So download that article and read it, please. And then there's a series of videos about risk and return, capital markets, bonds and interest rates. There's that number we talked about, beta, the capital asset pricing model, and stocks and bonds. All fairly short videos that all you need to do is just click on and watch the video and up it will come. And remember, we also have all these videos at our YouTube site that I talked about in the introduction video. So your job this week is to get up to speed on all this stuff, get used to our course, and then on Friday in my Friday weekending update video, I'll talk a little bit more about specifics that'll get you prepared for your first case study, which will be happening in another week or so. So again, I'm available on Tuesday and Thursday nights from 6 to 8 if you have any questions or concerns. Please do your discussion posts. I'll review it and post the grade as soon as you finish. It's a good way of getting a good solid start in our Business 630 MBA Corporate Finance class. We're going to be covering a lot of material in this class with a lot of research. Make sure you know how to use our library or learn how to use the databases, which there's a video, and I talked about that in our introduction video. Make sure you know how to use that. You'll be using that as an online student aplenty this spring too. I look forward to working with all of you. I will be meeting you and discussing with you personally, individually, next week in week 2, where I'll set aside 10, 15 minutes over the course of that week number 2, where you all zoom in and talk to me individually, just so I can get to know you and address any concerns you might have. And I'll be posting that schedule with our Friday video this coming week. Well, have a great week, everybody. Again, if you have any questions, please feel free to send me an email, post to the discussion forum, and I'll be happy to get you feeling comfortable about this class. Have a great week, everybody. Look forward to working with you, and we'll see you all again on Friday. Adios.